All right, let's talk about a fascinating stock today, EPSM. This thing is the definition of a perfect storm. We're talking massive risk, but also potentially huge reward. It's sending out so many conflicting signals, probably fueled by a mix of pure speculation and just real uncertainty about its future. So let's try and break down what is really going on here.
First, to give you an idea of the sheer roller coaster we're dealing with, just look at this number. In the last 3 months, EPSM hit a peak of $155. That's a huge ceiling, and you can bet every trader out there was watching it.
But in that exact same 3-month window, it also cratered to a low of just $9.01. I mean, the gap between those two numbers is just staggering. This isn't your everyday volatility. This is a genuinely gut-wrenching ride. And that brings us to the central puzzle of EPSM. The technical analysis actually spits out a strong buy signal, but in the very same breath, it warns of significant risk. So how can both of those things possibly be true at the same time? Well, that's the big question we're going to dig into.
Yeah, this isn't just a stock. It's a contradiction playing out in real time. On one hand, you've got signals that are just screaming opportunity. And on the other, you've got these massive red flags waving danger. So let's dissect this conflict, and we'll start with the case for being optimistic. So why on earth would any analyst slap a strong buy rating on a roller coaster like this one? Well, it turns out if you dig into the data, there are some pretty compelling reasons on the bullish side of the argument.
So what's really behind all this positive buzz? Let's pull back the curtain and look at the specific technical indicators that are flashing green, the ones telling traders that this thing might just be ready to take off.
Okay, so here's the why behind that strong buy. First off, the ADX indicator is at 52.7. Now, anything over 25 is considered strong, so this is basically screaming that a powerful trend is happening. Then, you've got this massive on-balance volume, which suggests that, hey, buyers are stepping in and accumulating shares, and to top it all off, the price is currently sitting above its short-term moving averages. That's a classic sign of upward momentum.
But you knew there was a but coming, right? For every green flag with this stock, it really feels like there's a red one. So now we're going to pivot to the other side of the coin and explore the case for extreme caution. And this is where the story gets a lot more complicated.
And wow, this chart just lays out the stock's split personality perfectly. Just look at this. The ADX says the trend is strong, right? But another key indicator, the MACD, is negative, suggesting momentum is actually weak. The price is rising, sure, but its link to time is weak. We'll get to that in a sec. And while one oscillator, the stochastic, is in oversold territory, which hints at a potential bounce, another one, the RSI, is just sitting there, totally neutral, offering no clear direction at all. It's a technical tug-of-war.
And that weak link to time? It all comes down to this one number, the R-squared value. At just about 0.14, it's incredibly low. Now, in simple terms, what this means is that the stock's price movements are super erratic. They don't follow a predictable pattern over time. It's moving, yeah, but it's not moving in a straight line. It's just all over the place.
Okay, so to understand where this whole battle might actually be decided, we need to quickly talk about two key concepts, support and resistance. Just think of support as a price floor, a level where buyers tend to show up and prop the stock up. And resistance is the exact opposite. It's a price ceiling where sellers usually take over and push it back down.
So these levels, these floors and ceilings, they create a kind of battleground. They are the specific price points where the fight between the buyers, the bulls, and the sellers, the bears, is happening, like right now.
And here is that battleground, all mapped out for us. The current price is sitting around $27. So the bulls, they need to push past two big resistance hurdles overhead. One's around $37, and an even bigger one is up near $40. Meanwhile, the bears are trying to smash it through the support floors down below, first at about $21.50, and then a really significant one down near $15.50. These are the lines in the sand.
So, when you put it all together, the bullish signals, the bearish warnings, and that price battleground, you can start to map out two very, very different potential futures for EPSM. And it really all depends on which one of those lines in the sand breaks first.
So this brings us to two pretty distinct paths. Let's look at the bullish scenario. The stock smashes through that resistance ceiling up at $37 to $40. If that happens, it could signal a major move higher. But in the bear scenario, it breaks down through that support floor at $21, and that could open the floodgates for a drop all the way to that next support level near $15.
But hold on. Before we get too focused on those two paths, we have to circle back to the single most important thing about this stock, its wild, completely unpredictable nature. And there's one final number that captures this perfectly.
And here it is. This is the average true range, or ATR. What this means is that on any given day, Epsium is expected to swing by over $12. So while we can sit here and talk about a support level at $21, the stock could blow right past that in a single trading session. This number is just a constant, powerful reminder of the immense risk we're talking about here.
So, after all that, we're left with this one fundamental question. The data shows us clear signs of strength, and it shows us clear signs of danger. It points to potential paths up and potential paths down. For a stock that is defined by this kind of extreme contradiction, where do you draw the line between a calculated opportunity and just a pure gamble? That is the puzzle of EPSM.